Good afternoon and welcome to PhillipCapital UK's webinar. I'm Andrew Hall and I'll be introducing you to Japanese candlestick patterns. Before I get started, let me tell you a little bit about who we are. PhillipCapital was established in 1975 and has its headquarters in Singapore. The PhillipCapital Group has grown into a global financial powerhouse with presence in 16 countries and over 1 million clients worldwide. PhillipCapital UK brings the heritage and expertise of the group to London to build long-term relationships with our clients and partners, offering online trading services in spot forex, index CFDs, spot metal and commodities, including both WTI and Brent. Our clients have access to top-tier and deep liquidity from both major banks and non-bank providers. We're regulated by the FCA, so clients can trade with confidence and ease, whilst receiving support from our experienced and multilingual account managers. Also, you may see on the slide in front of you the demo account hyperlink. So yeah, if you haven't done so already, I would advise opening a demo account with us. It's very simple to do and is a direct representation of our live account. In your demo account, you can test your trading strategies with 50,000 worth of virtual funds. Why not test some of the trading theories learned today within your demo and see how you get on. Today, we'll take you through the origins of Japanese candlesticks, looking at how and why we use them in trading today. We'll also go through the various different types of candlesticks, looking at both the different types of bodies and the anatomy, before concluding with the top 5 candlestick patterns, analysing how these are applied to financial instruments. But I'm afraid before we get going, I do need to go through a quick disclaimer for you guys. So bear with me, it's not the most interesting. CFDs are complex instruments and come with a high risk of losing money rapidly due to leverage. 52% of retail investor accounts lose money when trading CFDs with us. You should consider whether you understand how CFDs work and whether you can afford to take the high risk of losing your money. The following webinar is for educational purposes only and does not take into account your objectives and/or your financial situation. The examples we use are not recommendation or solicitations to trade, nor should they be taken as advice. More information can be found on UK business terms and conditions on the link you see there in front of you. Right, so this brings us nicely on to the origin of Japanese candlesticks. Japanese candlesticks, funnily enough, as the name suggests, originated in Japan in the 18th century, when traders developed their own technical analysis to trade rice. It was not until the 1990s when it was introduced to the Western world by Steve Neeson. He's quite a famous author on this subject, and he wrote a book called Japanese Candlestick Charting Techniques, a contemporary guide to the ancient investment techniques of the Far East. Like I said, if you do find this webinar interesting today, have a look up for sort of books on this subject, including Steve Neeson's, as this will help sort of develop your understanding within this. So yeah, like I said, yeah, he was a leading writer in this field, and basically, each candlestick is designed to be easy to view. So the trader can see the open, high, lows, and close price. So yes, Japanese candlesticks are a visual aid that are used to describe the price action during a given time frame. This could be a time frame akin to the euro sterling example below, which is day one. Again, like I said, it comes down to sort of your platform that you use, but within MT4 you can also have sort of minute 1, minute 5, minute 15, so on and so forth, all the way up to 1 month. So again, it all depends on sort of your trading, what you're trying to do, whether you're looking for perhaps long-term gain, or even perhaps you're trading in the short term. But again, it just comes down to your strategy and sort of what you're looking to do. So investors will use the candlesticks to monitor trend patterns, assessing an instrument's opening and close price, its high and lows, to help you make an informed decision in the foreign exchange, commodity and index CFD markets. Investors will also look at the intensity of trading, assessing the buying and selling pressures within the market itself. So in the euro sterling example below, you see the formation of a bullish trend for the euro against the pound. I mean, this is a common trend of late, considering the Brexit uncertainty. You tend to read about sort of every day. There's always sort of to and fro in, and like I said, that is sort of damaging, the pound at the moment. In this section, I'll quickly run through the anatomy of candlesticks so that you can quickly identify the key features. This is essential as it will enable you to make a time-effective decision in correlation to your trading activity. So again, it's what you want to be able to do is to view a candlestick quickly, assess it, and understand exactly what's going on in the market. Japanese candlesticks show you, as I specified earlier, the high, the open, the close, and the low price. The bit in the middle is called the body, or sometimes it's referred to as the real body, whilst the lines above and below are the shadows that will mark the high and lows. Again, you can see the examples on the screen in front of you of both an increasing bullish candlestick, which would be black on your MT4 platform, and a decreasing bearish candlestick, which will be white, or sometimes referred to as hollow. Again, if you notice, you can see that the open and close are inversed on those. So yeah, look out for those in the slides coming up. Just like us, candlesticks have both long and short bodies. The longer the body, the bigger the difference between the open and close price. As a general rule, the longer the body, the heightened buying or selling pressure in the instrument during that period of time. Naturally, there is less price movement in a shorter body candle, with price consolidation taking place. You can see examples of these in the bottom left-hand side diagram. A long black candle shows a strong buying pressure, whilst a long white hollow candlestick shows strong selling pressure. Again, like I said, you can see the example there on the screen. We'll now start to look at different types of candlesticks. Initially with the spinning top, before moving on to the Marubozu and concluding on the doji. As you can see by the two pictures either side of the text, the spinning top is a single candle consisting of a small real body, long upper shadow and long lower shadow. In fact, those of you who are old enough may remember that spinning top was a popular toy in the 70s. Again, consisting of a small base, large central body and thin top section. Again, this would rotate and spin rapidly on the ground. Again, it was quite popular back in sort of the 60s and the 70s. Anyway, back to the candlestick. As you can see, the instrument's opening and close price is largely unchanged, although the pattern does demonstrate intense buying and selling, as the price jumps significantly higher and then slumps significantly lower. The pattern represents heightened indecision in the market between long and short sellers. So ultimately, the open and close do not change too much, but within that set time period, there's a lot of sort of activity, and as you can see by sort of the shadows, both above and below the real body. Unlike the spinning top, the Marubozu has no shadows above or below the real body and indicates an instrument's trading strongly in one direction. hence the long body. The longer the candle is, the more dramatic the jump in price will be. Within a bearish Marubozu, the seller has complete control of the market throughout the period in question, with the opening price equaling the high price and the close price equaling the low price. The inverse is true for a bullish Marubozu in black on the graph in front of you. So the opening price equals the low price and the close price equals the high price. Please see the diagram below. So again, like I said, the bullish Marubozu, the close price will be at the top there, and the open price will be down the bottom. So in other words, it's jumped up. The final type of candlestick I will specifically assess for you is the doji. The doji is characterized by being small in length, with the open and close being either exactly the same or their real bodies are extremely short. Therefore, the price movement is at most minimal. Doji candles demonstrate trading indecision as sellers and buyers tussle for dominant position. All traders should pay close attention to the preceding candlestick. Has a bearish trend come to an end, like the example below on the sort of bottom right of your screen? So again, it's there is obviously, the price is jumping, but ultimately opening close price hasn't changed too much. But you've got to look at sort of what's happened there, and then with that information you have, is it bearish, is it bullish, and then go from there. Again, it's you can also see on your screen there are different types of doji candlesticks as well. So I've got 4 types there for you to see. So moving on, I will now discuss the top 5 candlestick patterns. There are other candlestick patterns we could have looked at, and if this webinar proves popular, I'm more than happy to go through them with you at a later date. However, whilst we're here, I will start with the 3-line strike. The 3-line strike can be both bullish and bearish. I'll explain the bearish model, just so you're aware the bullish model would be the inverse of the below. The bearish 3-line strike consists of 4 candles, 3 of which are declining and recording a lower close price, whilst the 4th will initially open lower again before reversing in a wide range outside bar to end closing higher than the first candle in the series. Again, you can see this in the diagram in front of you. Thomas Bukowski, a leading author in the field and investor with over 30 years experience, attributes a 84% accuracy to this chart pattern. Again, like with all charts, there's no guarantee that sort of this will happen, but again, it's good to know the percentage of accuracy can help you with your own trading strategy. The next candlestick pattern I'll talk through is the 3 black crows. This is a bearish reversal pattern that investors use to predict an upward turn. The pattern involves 3 long-bodied candlesticks, with the second and third candle opening within the body of the previous candle. The body of the second candle is usually larger than the first candle. Again, you can see this on the diagram there. Whilst the third candle is around the same size of the second candle, with little or no lower shadow. The accuracy of this pattern increases if the bullish upward trend leading to this pattern occurred with relatively low volume, whilst the 3 candles within the black crows consist of relatively high volume. This pattern tends to work well with the relative strength indicator, RSI, so that you can assess whether the instrument is being oversold. 70 on the RSI is considered to be overbought, whilst 30 is considered to be oversold. However, some traders like to use this, like to let it run slightly beyond those limits before hitting the market. Again, it comes down to sort of you as an individual. I will now review the candlestick pattern 2 black gapping, which is considered a continuation of a downward trend, with a gap down that yields two black bars posting lower lows, like you can see in the diagram there. Belkowski forecast lower prices with a 68% accuracy in this model. So again, you can notice that sort of the accuracy percentage on this has gone down a little bit from previous, but again, it's worth looking out for these patterns. The morning star. The morning star is a free candlestick pattern viewed as a bullish sign by investors looking to capitalize on a trend reversal to the upside. The first candlestick within the series occurs within a well-defined downtrend, is bearish and has a relatively large body. The second candlestick is the namesake of this pattern, the star, and has a short body. The gap between the bodies of the two candlesticks distinguishes the star from a doji or a spinning top. The star acts as the first indication to the investor of the inherent weakness, as sellers are no longer able to force the price lower than the previous close. Again, you can see this on the diagram. So if you see the second candlestick there, it's not been able to force any lower, despite the fact that there's been, the price has gone up and down during that time period. The third candlestick must close well into the body of the first candlestick. Again, please see the diagram, showing this. You can see that the bearish trend has sort of come to an end, and you can now see the bullish trend taking place. If the volume on the first candlestick is below average, the reliability of this pattern is enhanced. The final candlestick pattern I'll discuss is the abandoned baby. I'm not sure who comes up with these names, but they are quite strange. But anyway, so the abandoned baby, it's a bullish pattern that is used by investors as an indicator of a trend reversal. The second candle will gap lower and forms as a doji candle as sellers fail to appear. The opening and closing price will be the same. A bullish gap on the third candle completes this pattern. A continuation of this upward trend is forecast as the recovery starts to take effect. Again, this is the right-hand side of the graph below that I'm explaining. The inverse there, is on the left-hand side. So, that's sort of you can see that there for yourself. According to Belkowski on this, this pattern predicts higher prices with a 70% accuracy rate. We now move on to the penultimate slide within this webinar, where I'll be looking at applying candlestick patterns, assessing the various considerations all traders must take. Firstly, candlestick patterns are a technical indicator forecasting probability and offer no guarantee of success. They're there to sort of plot trends. Nothing can or should be taken for granted when trading within Forex markets. Again, I'm sure you already know that. Past performance doesn't predict future performance. That's like I said, I'm sure you guys are already aware of that. Also, Japanese candlesticks should be used in conjunction with other technical tools, whilst fundamental factors should also be taken into consideration, as key market data will move markets. This is both increasing the volume traded and volatility. So again, like I said, some of these patterns, the accuracy may not be the same if you're trying to trade around fundamental data releases. That will swing the market. Remember also to continually review your trading strategy, looking at ways you can improve, and try not to move your stop losses. Remember, you put them there for a reason. My final slide combines candlestick patterns with support and resistance levels. Hopefully you guys were able to be with us for our webinar on support and resistance. Again, if you were, the two together work very well. So hopefully you can use that knowledge to improve your success rate with us. The graph below shows the formation of a bearish three line strike. Again, this is sort of circled within that red, in red on the graph there. We covered this earlier as well, the free strike. in this webinar. Whilst I've added both the minor resistance and minor support levels, again that's the blue lines there. As you can see by the example below, by utilising your knowledge on support and resistance and candlestick patterns, you could choose to enter the market long at 1.28719, the minor support level. This would be prior to the bullish momentum taking place. If you were to then add a take profit close to the minor resistance level, say at 1.28843, you would have gained 12.4 pips. However, please bear in mind, past performance is not indicative of future results. But again, it just gives you an idea of how you can use candlesticks alongside other sort of technical tools such as supports and resistance levels. Again, it's assessing. It may be just the first candlestick you see, and you're trying to form a pattern there and think, okay, so what's going on in the market? But I mean, again, like I said, it's well worth using the support and resistance levels with candlesticks. Right, so that actually brings a close to our webinar today. I'd like to thank you all for joining us. If you do have any questions regarding what has been discussed, please reach out to our support team. They'll be more than happy to help. Also, keep your eyes peeled out for our next webinar, which in actual fact is tomorrow at 12 British Summer Time, and is on the topic of preparing yourself for the next financial crisis. Quite doom and gloom there, but again, it's good to know what's coming out, and like I said, you need to be prepared for all eventualities. Like I said again, thanks for joining us today, and enjoy the rest of your evening.